Imagine a shadow government, not of politicians or armies, but of economists and central bankers, quietly orchestrating the very pulse of global finance. Their decisions, often made behind closed doors, have the power to elevate nations, cripple economies, and fundamentally redraw the map of banking power, all under the innocuous-sounding banner of stability. We're talking about the Basel Accords, a series of international agreements that, for decades, have been the unseen hand guiding the world's most powerful banks, shaping their fortunes and dictating their reach. But what if the pursuit of safety inadvertently built a system that paradoxically empowered the few at the expense of the many, creating a landscape far more volatile than anyone truly understands? Before the Basel Accords emerged from the shadows, the global banking system was a wild, untamed frontier. Banks operated with varying levels of capital, making international comparisons a nightmare and trust a luxury. The late 1980s saw growing recognition that this patchwork of national regulations was a ticking time bomb, ripe for a systemic implosion. The solution, or so it was hoped, came in 1988 with Basel Occam. This was the very first attempt to impose a universal language of risk, demanding that banks hold a minimum level of capital against their assets. It was a seemingly simple equation. More capital meant more safety, a cushion against potential losses. Its primary aim was to level the playing field, ensuring that banks in different countries weren't operating with wildly disparate risk appetites. But beneath the surface, it began the subtle redistribution of financial gravity, inadvertently rewarding those who could most easily adapt. The global banking community, accustomed to their national fiefdoms, was suddenly being asked to play by a unified rulebook, a precedent that would forever alter the autonomy of financial institutions worldwide. This seemingly benign rule, a first step towards order, concealed the seeds of a profound power shift, setting the stage for an even more complex future. But the pursuit of simplicity quickly exposed its own limitations. A Basel the Fils, with its broad brush approach to risk, treated all loans to corporations, for instance, as equally risky, regardless of the borrower's actual creditworthiness. This led to what many critics called regulatory arbitrage, where banks sought out complex ways to game the system, holding less capital than the spirit of the rule intended. The world needed something more nuanced, more sophisticated, a system that could differentiate between a highly solvent multinational and a struggling startup. This ambition birthed Basel II. In 2004, a monumental leap forward in complexity, designed to be more risk-sensitive. It introduced a three-pillar approach: minimum capital requirements, supervisory review, and market discipline. Banks were now encouraged, even urged, to develop their own internal risk models, allowing them to calculate their capital needs with far greater precision. The promise was a more robust, intelligent system, one that could bend but not break. However, this increased reliance on internal models, while appearing to be a triumph of data and analytics, contained a hidden danger. It gave immense power to the banks themselves to define their own risk, a power that, as history would soon reveal, was catastrophically misplaced. The grand edifice of Basel II, Merced Beansodar, ou Caso Basetung, designed to prevent financial catastrophe, crumbled under the weight of the 2008 global financial crisis. It was a shocking, brutal awakening that exposed the deep flaws in its design. Banks, armed with their sophisticated internal models, had collectively underestimated the interconnectedness and systemic risk bubbling beneath the surface. Mortgage-backed securities, once deemed safe by these models, unraveled with dizzying speed, taking down institutions that were supposedly well capitalized. The crisis wasn't just a failure of individual banks, it was a devastating indictment of a regulatory framework that was too complex, too reliant on the very institutions it was meant to oversee, and ultimately too slow to respond to rapidly evolving threats. The sheer scale of the meltdown, the government bailouts, and the ensuing recession sent shockwaves across the globe, forcing policymakers to confront an uncomfortable truth. The existing system hadn't just bent, it had shattered, and an even more aggressive, intrusive intervention was desperately needed to prevent a repeat performance. The very notion of trust in the banking system had evaporated, demanding a response that would redefine financial power. From the ashes of the 2008 crisis rose Basel III, a desperate, sweeping attempt to rebuild trust and fortify the global financial system against future shocks. Unveiled progressively from 2010, this was not just an update. It was a radical overhaul, dramatically increasing the quantity and quality of capital banks were required to hold. It introduced new measures like the liquidity coverage ratio, LCR, and net stable funding ratio, NSFR, to address liquidity risks, ensuring banks had enough ready cash to weather a storm. A leverage ratio was also added, acting as a backstop to prevent excessive borrowing, even if other risk models suggested otherwise. The intent was clear: make banks fundamentally safer, more resilient, and less reliant on taxpayer bailouts. But this newfound stringency came with its own set of dramatic consequences, particularly for smaller banks and those in emerging markets. The compliance costs, the complex new calculations, and the sheer volume of new rules created an uneven playing field. While ostensibly designed for global stability, critics whispered that Basel III was subtly designed to consolidate power within the largest, most entrenched financial institutions, essentially baking in the too-big-to-fail doctrine through a new, more impenetrable regulatory shield. Yet, the implementation of Basel III was far from a uniform, smooth process. National interests and varying economic conditions led to a fragmented adoption, creating what some called a Swiss cheese effect, where different countries implemented the rules with varying degrees of rigor and interpretation. The United States, for instance, quickly adopted many of the core tenets, but other regions, particularly the European Union, faced significant political and economic pushback, leading to delays and sometimes softer interpretations. This uneven rollout became a new battleground, sparking accusations of regulatory arbitrage on an international scale and raising questions about the true effectiveness of a supposedly global standard. Critics argued that the accords, while well-intentioned, fostered an environment of regulatory burden that stifled lending, particularly to small and medium-sized enterprises, and disadvantaged developing economies, struggling to meet the new, stringent requirements. The debate raged. Were these rules truly making the world safer, or were they merely creating a new form of financial engineering where only the largest, most sophisticated players could truly thrive, leaving the smaller, more agile institutions struggling to keep pace, further cementing a two-tiered system of financial might? The story doesn't end with Basel III. It continues with what's often unofficially referred to as Basel IV, a set of finalized reforms that have sparked heated controversy and revealed the deep fault lines in global banking power. These reforms, primarily focused on reducing the variability in banks' calculations of risk-weighted assets, aim to limit the discretion banks have when using their internal models. Essentially, the regulators are saying, we don't entirely trust your numbers, so we're giving you less room to maneuver. This includes setting floors for risk-weighted assets, ensuring that even the most optimistic internal model can't go below a certain threshold. The banking industry, predictably, has pushed back hard, claiming these measures are overly punitive, will significantly increase capital requirements, and will ultimately hinder economic growth and make lending more expensive. This isn't just a technical debate, it's a profound struggle for control between global regulators and the world's most powerful financial institutions. Who gets to define risk? Who holds the ultimate power to dictate capital? The stakes are astronomically high, with some analysts predicting a substantial impact on bank profitability and, more importantly, a potential reshaping of the competitive landscape, further favoring the colossal, well-established players who can absorb the compliance costs and capital buffers, leaving others to fight for scraps. So, who truly benefits from this labyrinthine network of global banking rules. While the stated goal is undoubtedly financial stability and preventing another catastrophic meltdown, the journey through Basel WEF sehr schön and threat, culminating in the ongoing debates around Basel WEF, reveals a more complex truth. These accords, far from being neutral, have fundamentally reshaped the architecture of global finance, subtly consolidating power within the largest, most interconnected banks that can navigate their complexities and bear the enormous compliance costs. They've created a world where regulatory capital isn't just a safety net, but a strategic weapon, dictating market entry, competitive advantage, and ultimately who gets to play at the highest levels of global finance. The constant evolution of these rules reflects an ongoing, silent battle for control, a perpetual dance between the forces of regulation and the relentless innovation of financial markets. The hidden hand of Basel, though often invisible to the public eye, continues to draw the lines of financial power, making some institutions indispensable, others vulnerable, and the global financial system a tightly controlled ecosystem where stability often comes at the price of concentrated influence, raising the disquieting question, are we truly safer, or have we simply exchanged one set of risks for another, more deeply embedded, more profoundly powerful form of control?